Hey team, welcome to part 2 of our 4-part credit spreads masterclass. In this video, we're going over how to grow a small account while working full-time. So this is great for you if you are like, Austin, I love the first video, I understood credit spreads, but I don't have that large of account. Or maybe I have a large account and I'm trying to build a side income. How do I do that? Or maybe, Austin, I don't have time to place trades during the day because of meetings and work and kids and family. Like, I just can't do it. How can I trade this? So I'm going to show you exactly how to do that, even if you can't place trades during market open. So let's dive right in. First off, disclaimer, I am not a registered financial advisor or tax expert. This is purely for educational purposes only. Next, if you stay till the very end of the video, I'm actually going to give you a free bonus for watching till the very end. So make sure you stay till the very end because you don't want to miss out on that. All right, so for the purposes of this video, we're going to do a recap of what our credit spreads real fast and just a short summary from what we discussed in Masterclass video number 1. Then we're going to get into the scaling framework, how to scale and grow your account. Then we're going to get into how to trade even if you have a full-time job. And then I'm going to show you a case study from someone who did exactly this. All right, cool. So first off, we're going to go in. Okay, so we have different types of credit spreads. Credit spreads make money in 3 different ways compared to a stock that only makes money in 1 way. When you buy a stock, you have to let the stock go up to make money. Credit spreads, you make money if it goes in your direction, against you, sideways, and you still make a good return. All right, so if you're setting up a put credit spread, you simply just select a level you think the stock will stay above. So the stock is trading here and you think it's going to stay above here. This is your level. As long as the stock stays above this level, you make money. Same thing with the calls, except it's reversed. So you pick a level, let's say the stock is here, that you think the stock will not go above. So as long as the stock stays below this level, you make money. So if it goes up but stays below, you make money. If it's neutral, you make money. If it goes down, you make money. So that's exactly how you structure these trades and set them up. If you want to learn more about the specifics, go watch Masterclass number 1. We also discussed in that lesson of how to trade with the trend, the idea that the trend is your friend. When you follow the big waves in the market, not only is it easier to trade stocks, but it's also way easier to trade credit spreads. And so you can see here, this is an uptrending market. We discussed why in Masterclass 1, and then a downtrend and a downtrending market. When you're in an uptrending market, you trade put credit spreads. When you're in a downtrending market, you sell call credit spreads because those make money to the downside while put makes money to the upside. And so that's kind of how these are played and structured, and that's the best and most consistent way to trade credit spreads. Now, my scaling framework, this is something I shared inside my Inner Circle program, but I wanted to share it for you guys. So this is exactly how you do it. So whether you have a $100 account, a $1,000 account, or a $100,000 account, this scaling framework is going to work for you. I have people using this framework who have $100. I have people using this framework like myself who have $100,000 and more. I'm not the only one who has that size of an account in the Inner Circle program, but these trades can work for you. First off, as we discussed, if you're trading credit spreads, you can have different types of spread widths. So for instance, if we go back here, you can see the spread width here is $1. Why? Because 409, 408, there's a $1 difference. Well, you can also make this a 409 and then buy the 40 or sell the 407 and buy the 409. That would be a $2 difference. I just want to show that for example. All right, so the scaling framework goes like this. Let's say you have a small account. What you want to do is you want to put no more than 10% of your account into any one trade. Let me make sure this is seeable. All right, 10% of your account goes in per trade. So what does this mean? Well, this is a risk management rule. So for instance, if you have let's say a $1,000 account, let's see if I can do numbers well with the mouse. $1,000 account times 10% equals what? 100. Now, how much collateral do you need to put up per trade? Well, as we discussed in the first video, it's $100 if you have a $1 width. So divided by the amount of collateral you need to put up per trade, that means you can sell 1 credit spread based on your account size. So per trade, you should put no more than 1 credit spread in or for that trade if you have a $1,000 account. Now you can put on multiple trades, but each trade itself should be no more than 1 credit spread. This is to help you manage risk correctly since your losses are going to be way larger than your wins. Now, this is how you structure it. Now again, if you have let's say if we add 2 more zeros here, that's going to be 2 more zeros here on the end. So if you have a $100,000 account, you'll be trading 100 spreads per trade. Now again, because of commissions that can eat up your profits, this is the proper scaling order. So we have number one, what we want to do is we want to trade 50 SPY, or 50 really any ETFs, but 50 $1 wide spreads. So for instance, 50 $1 wide spreads would mean that we are trading with, let's say, one credit spread. We could do the inverse, but let's say you have a you can't see that well here. I'm just going to do here. So for the first one, I'm going to say you have a, I think you're going to max out around 50,000, right? Because 50,000 times 10% is going to give you, can I do math? 500. Is that even right? 500. No, that's not right. 5,000. Okay, 5,000. Then divided by 100, because that's a $1 wide. Then you'll get 50. So that means that at this size, you're going to max out on scale number one at $50,000. So from 100 to 50,000, this is the method you follow. You're going to stick to $1 wide spreads. You're going to trade those consistently until you are growing your accounts, which you'll be able to do quickly with credit spreads, and you hit $50,000. After that, then you want to move to the next part, which is going to be doing the same thing, but with a $2 wide. When you do a $2 wide, instead of dividing by 100, it's going to be 200. Why? Because your width is 2. So again, now you're going to be moving down to 25. So if you're trading at the same consistency, but then you do the $2 wide, this is going to move your new credit spreads to 25 per trade, until you'll slowly start to scale up with that. And this next scale up will be double this, so it'll be 100,000. So once you get to 100,000, and you're using the proper risk management, if you can understand this right here, 100,000. So once you hit 100,000, then that is going to be when you max out of this second scaling tier. So from $100 to 50,000, you'll be trading scale 1. From 50,000 to 100,000, you'll be trading scale 2. And then after that, the sky is the limit when you move to SPX or ES futures. Why? Well, because I have personally spoke with options hedge funds that have over $10 million in assets under management, some as high as $15 million. They are trading spreads for their consistent strategy. First off, that should show you how well credit spreads work. If hedge funds with millions and millions of dollars are trading spreads as their main strategy, this should be something you're doing too. But not only that, they're trading SPX and ES futures, and they're trading millions and millions of dollars. Therefore, the moon is the limit, or the sky is the limit, right? When you're trading size with these. Not only these, when you get into this higher scaling bracket, you also get tax advantages as well. But we can talk about that another day. All right. So that is the scaling framework. Now, how do you do this with a full-time job? As I showed you in Masterclass number 1 and kind of highlighted on today of how to set up trades, when you set up a trade, you can actually go to this little thing right here. Let me bring this little thing right here, which is TIF, or basically how long do you want this order to last. This should be on almost every broker platform. It goes, do you most say good till cancel, or you can also do good till the trading day or until the end of whatever. But anyways, you want to make sure that it says GTC or good till cancel. Why? Well, because if you put in the minimum credit that you need to collect, let's say 15 cents, let's say you do this at night when the market's closed. You say, okay, if I want to enter this trade, I need to at least collect this much money. So you put that in as your limit order. You set it. You put a good till cancel. You click review and send. Now your order is sitting in the market for whenever the market opens next, and whenever it gets to your price, it will automatically fill for you, whether you are in a meeting, whether you are with your kids, spending time with them, no matter where you are, this will fill for you automatically. All you need to do is take 5 minutes max at the end of your day, or maybe when you start the day before you go to work. So you put on this trade and it will fill for you automatically. So this is how you can do it with a full-time job. It's exactly how my Inner Circle members are doing it. So again, here's a study from JD. So JD Griffin, he is someone I love. Why? Because he not only loves personal finance and has been in it for a while, but he also works full time. He's very much works. He only checks his trades at lunchtime when he goes for his lunch break. But he is a CPA, and he loves the Atlanta Braves. So if anyone loves that, way to go. He also loves to vacation in the Smoky Mountains. And oh my gosh, I love the Smoky Mountains. They're so beautiful. But anyways, you can read more about his journey here if you pause this video. But basically, he started with this credit spread system. He had no experience with options or any type of this credit spread experience. He works full time, so let's mind you that is that his time is very limited. So he started using the scaling system. He started using the good till cancel system, and guess what? Now he's had 15 green trades in a row since starting this program. So that means 15 trades without losing. Who here would like to have 15 green trades in a row? That's exactly what he's done, and he's up to even more than 15 now. But he grew his account by over 11% in 1 month. Who here would like to grow their account by 11% in a single month? That is the beauty of credit spreads and following a system like this. If you want to learn exactly what this system is and how JD did it, how I do it, and how our members do it, stay tuned for Masterclass video number 3, because I'm going to go in depth. I'm going to give you everything, all my strategies for you step by step. So make sure you stay tuned for that. But anyways, if you want to place a credit spread right now, here's my free bonus and gift to you. Because you watched this entire video, I'm going to give you my free alerts that are working right now. So go open your broker account or go create one if you don't have one yet. Enable options and follow one of these alerts. If you want to get these free alerts, click the button or the link below. Simply go to this page, scroll all the way down to the bottom and click on Get Our Alerts. I will send you as many free alerts as I can. I'll also give you some bonus training so you know how to place those alerts step by step. Not only that, you'll also get alerted to the next Masterclass series that are coming. So for instance, Masterclass number 3, where I share all my strategies in depth, step by step, so you can do this for yourself. That is coming and you don't want to miss out. So make sure you put your email so that you don't miss out. Anyways, guys, thank you so much for watching. I hope you enjoyed this video. Masterclass number 2 on how to do this with a full-time job and scale your account. If you didn't, I'm sorry, but if you did, thumbs up, subscribe. See you in the next Masterclass video. You don't want to miss out.